If you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the US is on an unsustainable path for debt. And that was 35 years ago. So for the next 35 years, you're going to hear the same thing. The US is on an unsustainable path of debt, yet it's probably not going to make a difference.
According to Tom Lee, the opportunity in Bitcoin remains massive because the majority of investors still haven't moved. Over 95% of them have zero exposure. That's despite the launch of major ETFs, billions in institutional inflows, and a surge in long-term holder supply, all signs of deep structural adoption. Quietly accelerating behind the scenes, Glassnode data confirms a trend: more active addresses, rising accumulation, and sustained holding behavior. Yet, the broader market still hasn't priced in what's unfolding. If you're getting value so far, take a second to like the video, subscribe to the channel, and drop a comment below with your thoughts. Every bit of engagement helps the algorithm and keeps this content flowing. Lee sees this moment as a rare asymmetry. Access is easier than ever, the infrastructure is here, macro conditions are turning, and still, malls remain on the sidelines. That disconnect, he argues, won't last. With fundamentals aligning and capital beginning to rotate in, he believes a repricing is not just likely but imminent. The window is open. The question is, for how much longer? Let's watch more clips from the interview.
What's your overall assessment of the market, where we are, and how do you anticipate the market in the second half and 2026?
Well, the stock market in 2025 faced a black swan because Tariff Liberation Day was a shock, and it created a downward spiral in stocks, falling 20% in the fastest pace, or one of the fastest pace in 100 years. There have only been 12 times in history that stocks fell a similar amount and a similar speed. And I think the mistake many people made was that shock turned people bearish. As you mentioned, we did think there would be a correction this year, but the reason I think we didn't turn bearish, even though this was a huge decline, is three things. One, we didn't expect President Trump to stick with the tariff terms. So even though in the beginning they claimed this was the deal and everyone had to take it, we thought they would eventually walk back those terms, which is what's happened. And in fact, what we've seen so far is the tariffs are much, much milder than many people thought at the start of the year. So we're actually in a better place. The second is many economists convinced you that there'd be a recession. Do you remember all these economists said a recession's guaranteed, and that's why everybody panicked and sold their stocks. But we don't necessarily listen to economists. We prefer to watch what the high yield market is doing. And the high yield market, while it showed some turbulence, actually moved in a way that said there might be a growth scare. So there's a difference between a growth scare and a recession. A growth scare just means everybody gets cautious, which is understandable. And the third reason we didn't turn bearish is that waterfall declines, like we saw, usually come back as a V-shaped recovery. And that was our argument, that this would be a V-shaped bounce. And in fact, we were pretty convinced of it because the VIX, which is a measure of volatility, jumped to 60. And if you look at the last 35 years, anytime the VIX has moved above 60, no matter what you think, you have to buy the stock market because that's pure terror. The market is so scared, they're not pricing anything, and that's why you have to buy that. And So stocks had a V-shaped bounce. And now that we're almost back to the old highs, I'm finding a lot of people are still bearish. Maybe in the audience, you guys are still bearish, thinking, I don't see why stocks came back, so I don't really want to buy the stock market now. But here's something to keep in mind. In 2025, we've already had a 20% decline. The chances of a 10% decline between now and year end is very low. It might even be statistically 0%. So maybe the stock market could trade sideways for a little bit, but the chances of us declining again are very low. Fed is not cutting rates right now. And Fed Chair Powell said he's not cutting interest rates because he's expecting inflation to rise over the summer because of tariffs. That might kind of make sense. I mean, I'd say if someone said that to me, I'd say I understand that prices should be going up because of tariffs. But that is not actually how monetary policy should be administered. The Fed is really supposed to overlook supply shocks. So if you have a supply shock, like a tax, and it causes a one-time rise in price, the central bank is not supposed to adjust monetary policy for that, because the Fed is trying to control demand, meaning if there's so much demand for something that it causes prices to go up, they try to tighten monetary policy. But because of tariffs is more like a supply shock, the Fed should actually look through it. The bond market is starting to make that conclusion. On Wednesday's FOMC meeting, the bond market disagreed with the Fed. Interest rates actually went down in the last couple of days because they don't believe the Fed should be on hold. And that's also been our argument, that the Fed, if they're not cutting now, they have to do more cuts next year. Maybe more importantly, most people think stock rallies are only because the Fed is easing, adding liquidity. That's why in the April lows, people were saying the stock market couldn't rebound because the Fed wasn't going to add liquidity. But guess what? We had a V-shaped bounce anyways. And so it shows you the central bank isn't needed for stocks to rally, but next year we think they're going to cut a lot, and that should support stocks. And as far as positioning goes, I don't think you really explained our view on sectors this year. At the start of this year, our top calls were industrials, financials, and tech. That was first, second, and third. Year to date, industrials, financials are outperforming the market, and tech is actually beginning to outperform. So that's really been our stance this year. But with the Fed cutting rates next year, I think that's going to be good for interest sensitive. So that should really support financials, and it should support small and mid caps.
Despite earlier panic over tariffs, inflation, and Fed tightening, the U.S. stock market has held its ground. Tom Lee believes we're now shifting into a more favorable environment, one where loosening financial conditions and a likely Fed policy pivot by 2026 could support both equities and crypto. But Lee doesn't stop at short-term cycles. He tackles one of the biggest concerns investors constantly revisit, the U.S. debt burden and the long-term role of the dollar. Warnings about ballooning deficits, rising borrowing costs, and a potential tipping point have circulated for decades. And yet, the U.S. still leads in global finance, dominant in capital markets innovation and corporate size. In fact, 21 of the 25 largest companies in the world are American. The dollar continues to power global trade not because the system is perfect, but because, until now, there's been no credible alternative still. Cracks are starting to show. Analysts and Bitcoin advocates like Samson Moe, Jack Mallers, and Michael Saylor argue these systemic weaknesses are exactly what make Bitcoin so attractive. Its fixed supply, global accessibility, and resistance to monetary debasement present a radically different model. As trust in traditional currencies arose, more institutions, countries, and individuals are taking Bitcoin seriously not just as an investment, but as a monetary alternative. Could Bitcoin become a global reserve asset? That may still be debated, but the momentum behind the idea is undeniably growing. Now, back to Tom Lee's outlook.
How we should look at, understand the physical situation and any potential risk here?
When you read the newspaper or you hear financial commentators, a lot of people tell you the U.S. is in trouble because of the deficit, and the U.S. has unsustainable debt. And that's true because we know the path for the U.S. debt is unsustainable. But here's the thing. When I started on Wall Street in the 90s, that's also what I heard on Wall Street. I remember our economists and our bond heads of fixed income saying the U.S. is on an unsustainable path for debt, and that was 35 years ago. So for the next 35 years, you're going to hear the same thing. The U.S. is on an unsustainable path of debt, yet it's probably not going to make a difference. That's my opinion. But I do agree that we're in a very strange world because the U.S. prints money and they print a lot of dollars, and yet the borrowing cost is really low. It's very mysterious to me, but I don't think today's levels represent any sort of break point. And here's a really simple way to think of it. One, dollars is the reason people have used, own bonds, right, and use the U.S. economy. And dollars are mostly used for speculation. For every dollar of GDP activity that we have, the dollar is traded in oil, bonds, equities 400 times. So as long as the U.S. is the most liquid economy in the world, we're going to print a lot of dollars and interest rates are going to stay low. And the second is that as much as you hear stories that say the U.S. is losing its importance, so the rest of the world is becoming more dominant, and that's why the U.S. is in trouble. One, again, I've heard that story for 35 years. Everyone's told me the U.S. exceptionalism has been over, and it yet has never ended. If you look at the 25 largest companies in the world, 21 of the 25 largest are in America. So just because U.S. borrowing costs might change, is Germany going to suddenly be the place where the next Mag 7 comes? Just because borrowing costs change in the U.S., will Germany suddenly be the next Silicon Valley? I mean, if you believe that, then you should bet against the U.S. I'm very skeptical of that. So I think you shouldn't make a portfolio decision thinking stocks are going to fall because someone told you the U.S. can't fund its deficit.
You did mention that you were one of the first on Wall Street to make a call on Bitcoin, but do you agree that Bitcoin, Ethereum, these cryptocurrencies will continue to do very well for the next couple of years?
Yeah, I think Bitcoin is, if you're buying Bitcoin today, it's still early. I don't think it's too late. So if you have zero exposure to Bitcoin and you feel like you missed it, 95% of investors have zero Bitcoin exposure. So you're still way ahead if you're buying Bitcoin today. If you look at Bitcoin wallets, comparing it to the internet, we're back to 1996 levels. Internet went exponential from 1996. So it's still the earliest days. I think Bitcoin is very useful because in the future, we're not going to be able to trust anything. Because cybersecurity, there's nothing secure anymore. We can sample your voice. Even someone takes our voice, translates into Korean using my voice, you'll never know what's true anymore. So you need to be able to trust a system. The blockchain, the Bitcoin blockchain is the most trusted blockchain. And that's why the United States wants to have 1 million Bitcoin. US companies are buying Bitcoin. Banks will soon carry Bitcoin as collateral. But Ethereum is really important too. Did any of you buy the Circle IPO or own Circle? Circle is a stablecoin, and they just went public 10 days ago at $31. It's now $242.
What is the ticker code?
CRCL.
CLCL.
Circle is a stablecoin. It's the second largest. Stablecoins are being pushed by the United States government. Here's the thing. Circle runs on Ethereum. Stablecoins run on Ethereum. So as stablecoins explode, Ethereum is the backbone for stablecoins. So I think Ethereum is going to make a big comeback as well. So I think those two are useful. And then Solana I like, but it's not nearly as used as Ethereum.
Bitcoin may have tapped $111,000 in May, but it struggled to hold above six figures. According to Tom Lee, that's not surprising. A lot of early adopters bought in at $100 or less. They've already hit generational wealth, and whether Bitcoin reaches $500,000 or $1 million doesn't really change the game for them. For those players, it's about locking in, not riding every last leg. But here's what's more important. While price cools off, the crypto ecosystem is heating up. Coinbase surged over 40% to June, fueled by momentum around stablecoins. The Genius Act and a Circle IPO. Institutional confidence in crypto infrastructure is clearly rebounding. Meanwhile, long-term holders are turning to staking as a strategy. Ethereum and Solana may be consolidating, but staking them allows capital to earn yield while sitting tight, turning sideways action into productive positioning, and institutions are watching. BlackRock, Robinhood, and others are expanding staking access, betting big on passive yield as a driver of future inflows. Crypto ETFs are also pulling in serious capital, with fee waivers and ease of access. They're onboarding both retail and professional investors at scale. So, where does that leave us? Tom Lee's view hasn't changed. This isn't the top. This is a foundation. ETF flows, staking income, crypto infrastructure rallying. It's not a blow-off top. It's a reset, a setup, a phase shift. And for those still sitting on the sidelines, this may not be the end of the story. It might just be the beginning. Quick pause if you're finding value in this. Hit that like button, subscribe, and let us know in the comments, are we in the next big crypto build-up, or just catching our breath before another move? Your engagement helps more than you think.